Microphone. Okay. Welcome, everybody. Apologies for the slight delay there. I was late for about a minute. Little coffee incident. Spilled my coffee. I do that. Rushing to get the stream going, and inevitably something will go wrong. So welcome. Thanks, everybody, for joining me. This is Volatility Barometer episode 24, I believe. Just a reminder for everybody, if you're not aware, we've had about 30 of them privately as well for just the VTS community. So if you do happen to want to subscribe to that, feel free. I don't really talk about the private community at all in the live streams, though. So yeah, we're on number 24 publicly, and we're going to try to do these every week. So thank you for joining, and of course, come back every week. You can subscribe to the channel. That'll help you get notified, and you're not going to miss any future streams. So I do have a lot to get to today. I'm going to get right into it. The rundown for today, I might actually change it a little bit. So the first thing we're going to do, the first segment's called Question in Focus, where I had several questions, follow-up questions about a recent video that I posted on the Other Clips channel, where I was talking about how I don't like selling covered calls at all. And hold on a second, let me turn off YouTube here. I can hear it behind. Wait a second. I don't know what's going on here. Is anybody here? Am I live? Are you guys with me? I see eyeballs, but I don't see any comments. I don't, my YouTube doesn't seem to be playing. Sorry, we're gonna slow this intro down a little bit here and make sure that everything is going. Interesting. Give me a comment if you actually are hearing me speak right now. Unfortunately, everybody, we don't seem to be live. Apologies. Let me try to clean this up on the fly here, doing this live. I don't know what's going on. I'm actually using that new restream. Doing this live. So it's working here. Oh, I am sorry, everybody. It doesn't seem to be working on the other one. So again, I mentioned restream. What I'm trying to do here is I'm trying to stream to multiple different places at the same time. And it actually should be working just fine. Why does it say live stream test number 1? That is not. It actually should be working just fine. Okay, well. This whole thing is a little bit of a debacle, but everybody's here. So let me start over again. So for the rundown, what we're going to do is we're going to answer some detailed follow-up questions about my opinion that selling covered calls is a poor strategy. And I understand, I do want to give a little disclaimer right up in the beginning. I understand how popular a strategy that is. It's typically sold to people, marketed to people as a income generating strategy, as this great thing where if you're holding the underlying stock, you might as well get paid for it. I understand it might ruffle a few feathers if I talk about all the downsides and why I personally feel it's really just not worth the effort. But hear me out. If you are one of those people that has, been doing it for several years and maybe you really do like it, hear me out. Give me a chance. I hopefully will present something to you that might change your opinion on that. But we'll get to that first. And I tend to go over on time, so that's why I said might change this a little bit. The second one, we'll just do a segment called Hot Off the Press, just talking about recent things that I changed or updates on the website or whatever. And then the third one, I think we'll just bump it to the next live stream where if we can get to it, that'll be great. We have had a massive volatility crush in the market recently, and my personal volatility barometer has touched some pretty low levels. So I did want to talk about that, but I suspect the covered calls and then the Q&A will take up the full hour. So let's get started. Let me just hit you with a brief intro, and then we'll get right into the covered call discussion. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so apologies again for the little mishap here. It does appear like there's far fewer viewers than we typically get. So I think I did do something wrong setting up that restream. I'm trying to get it out to Facebook, to LinkedIn, and both the YouTube channels at the same time. And I seem to have made an error. So I think it's probably only showing up on one of the 4 places and probably not where I wanted it to. But anyway, it'll be available for the rebroadcast for anybody who wants to follow. And what I might do is chop this section and actually just upload it as a video, because it'll get to all those people that are typically here but are seemingly not here now. So like I said, we're going to do a full covered call discussion. And the first thing that I want to get into is the reason that I'm doing these follow-ups is I had an email question as follows. It says, recently you've uploaded a video clip talking about how you don't like selling covered calls, which is true. I uploaded that. It was about a 5-minute clip. I explained very briefly, didn't really get into too many details. And of course, naturally, because covered calls are such a popular strategy, I had a lot of follow-up questions. So the question essentially was, aren't covered calls part of your Wheel of Fun strategy? So this is another strategy that I employ, that I actually do sell covered calls as part of that strategy. And then another follow-up question, I was just briefly looking at the questions in the YouTube section as it was coming up. Another person was talking about how we also sell VXX put options, and on a quasi-inverse relationship, it's basically the same thing. So I will address both of those points later on. But first of all, we will get into what is a covered call, so we can get all of you caught up and up to speed on what it is and what we're talking about. Very, very popular option strategy. Number 2, why I don't like them. And again, keep an open mind, but I think after you see the data, you'll start to understand why I don't personally do them. And then C, we will look at both the exceptions. I will add that second exception as well with selling VXX put options and why that's not different, or why that is different. Okay, so first of all, what is a covered call? Well, very simply, let's just take a baseline example of the SPY. Let me just double check I'm on screen share. Perfect. All right. So we're taking the SPY, the S&P 500. Now, what a covered call is essentially, I'll delete these. A covered call it's called covered because you actually hold the underlying stock. So the first thing that I'm going to do is I'm going to just basically set this up so I'm holding shares of the SPY, 100 shares of the SPY, right? So we're going to buy 100 shares of the SPY. And that trade naturally looks like this, right? Here's today's price right there. And if it goes down, you lose money. And if it goes up, you make money. It's just a standard 100 shares of the S&P 500. Now, what the covered call is an option strategy where you can come in. Let's say November's a little far out, so we're going to go December. Sorry, it's a little bit too close. Typically, people talk about monthly cycles, but we'll go 42 days here. What you can actually do is employ this option strategy where you are selling an out-of-the-money call option. So let's say you sell this 480 SPY expiring in 42 days. Now, what that's going to look like, just the call option that you sold, Remember, you don't actually hold it. You are selling something, and somebody's on the other side of the trade. They are holding the option. But this is what the profile looks like. So here's today's price. You can see that this profit range extends all the way to the left. So it doesn't matter how far the S&P goes down. This trade will not lose any money. And it will actually still make the full profit right up to and including the strike price that was sold at 480. So seemingly, if you pair this with an underlying holding of the S&P 500, you seemingly have a trade that really, as it's marketed anyway, what people will often say to you is that there's really no downside because I'm basically collecting a small premium to do what I was going to do anyway, which is hold the underlying SPY. Right? Remember, the underlying strategy is holding the shares. So the covered call just comes in and says, look, I'm going to be holding this. We're not planning to sell our shares. We're hoping the stock market goes up. But why not generate a little bit of income? That word gets thrown around a lot, which really bothers me as an option trader, but income. And why not just sell this and make a little bit of extra premium? So this is actually what the covered call is. It's very simple strategy. Since you are holding the underlying shares, most people in most trading accounts are allowed to do this on its own. This is a naked short call. You probably wouldn't be allowed to do this. But if it's covered, if you hold the underlying shares, then worst case scenario, you are going to lose your shares. So essentially what ends up happening, there's basically two outcomes. On expiration, and let's just assume you're going to hold it until then. On expiration, if the SPY closes at 480 or above, you will keep your premium. That's yours no matter what happens. So your $2.68, that's yours. And then you will actually lose your underlying shares. They will be called away from you, and you will be left with no trade, no position on. You will have made money, right? The price is right here. It goes up. You will make money. So seemingly no downside, right? And then on the low side, we can adjust this a little bit. Because you're getting a little bit of extra upfront premium, it does reduce your risk a little bit because now your break-even point 42 days from now is a little bit lower, right? It's down to here. Might not seem like much, $2.67. We'll get into that in a second. But this is why people are able to market it. Now, hopefully I haven't done too good of a job in that very short 2-minute explanation, convincing you to actually go out and do this because on first glance, it does seem like a pretty reasonable strategy, right? If you're a long-term buy and hold investor, what the actual underlying SPY does doesn't really affect you that much because you're not planning to sell it, right? So the idea of generating premium on something, basically renting it out to the market, this is very appealing to a lot of people. And what you will often find, before I get into the reason that I think it's such a downside, where's my screen share? This is the chart that you will often see. Nope, not that one. The chart that you will often see posted is actual evidence. Sorry, it's a little blurry. I pulled it off Twitter at the last minute. But the actual evidence that people show that selling covered calls works is what you can see here. This is a back test, or some of this is a back test. A lot of it is live for an index that actually exists called the BXMD index. This is the SIBO S&P 30 Delta Buy Right Index. And this is essentially the same thing. It is holding the underlying S&P 500 and then selling a 30 Delta option, basically 1 month option. So we'll see how close I got to that. Check the delta of this option, 25. So it would actually be selling this 477, maybe the 478. So very, very close. We can actually, if you want to be exact, we can sell that 478. That's what that underlying index is doing. And we can see clearly that it has outperformed the SPY. Right? The S&P 500 is the second best performer. It's there in blue. Pretty close, but selling the green obviously generated a little bit of extra income. I shouldn't throw that word around. It really I don't like that word in the options trading world at all. No part of option trading should be considered income. It is trading with ups and downs and no predictability short term. Medium to long term, fantastic. Short term, there's no predictability there. So don't use the word income. But clearly the green, we have actual evidence to show. The problem is not all market periods are the same. And I had somebody on Twitter show me that chart. I've already seen it before, but that's the standard thing. Somebody shows that chart and says, see, selling covered calls works. And what can you do, right? I'm a data generating, I'm a evidence-based person. When you see the evidence, what can you do, right? The problem is markets are different and markets do change. And markets, I have always made the case that systematic vol selling, not to say that it will never return as the golden years, but it had already had its golden year period, certainly in the 90s and the early 2000s, where that type of thing, where you're basically blindly selling premium, the markets, the option markets, weren't sophisticated enough, and there was actually opportunity to do that. And that's what that chart is showing. But let's look what happens in the last, say, 10 or 12 years. So we'll pull up that index. And this is what it is, the BXMD index. It is selling 30 delta puts, right? You can check the SIBO website and get the performance every day going all the way back to the late 80s. And here's what we're looking at. From 1990 until now, clearly the BXMD is better, right? So this is the evidence that selling short covered calls is a good idea. But what happens if we try to find a market after the financial crisis? Well, now all of a sudden, the SPY is crushing the BXMD index. It's significantly ahead. I don't know if you can see the percentages here, but it's solidly ahead, right? This is adjusted for the same price at the beginning, and all of a sudden, 10 or 11 years later, we are at a price where the S&P is far superior to this underlying covered call strategy. Well, why is that? Well, if we look at this trade that I built, there's a few things that we can notice. So first of all, your trade is capped gains at a 30 delta option, right? Anything above a 30 delta move in the S&P 500 is going to cost this position money. So when it goes to this 478 strike, anything above that, you are now going to have to do one of two things. You're either going to have to buy back your call. If you want to keep your underlying shares, you're going to have to buy that call at a loss, take the loss and keep going and push it to another month. Or you can just let the whole trade close and you're done. You lost your underlying shares. That probably wasn't part of your plan. A lot of long-term investors don't like to lose the shares because of tax reasons or just complexity within their portfolio. So it certainly wasn't part of the plan. So typically what they will do is they'll just buy that call back so you don't have to actually, lose your shares. This process, whoa, that's terrible. Give me 1 second here to turn down. Okay, one second, sorry. Turning the ISO down. I don't have my ND filter on my camera. Sorry about that. Sun just popped out. It's Vancouver. It's never supposed to be sunny here. So what was I saying? So what ends up happening with that systematic strategy is, sure, you will get some months where you sold your covered call, you collect the easy money. Maybe the SPY went up, maybe it stayed flat. Nothing really happened, you don't lose your shares. And you feel like you generated income, right? But what happens often is you might get into a situation where the S&P 500 is moving more than expected. We have 42 days to expiration. We are right now at 468, and it's only to 478 when we are going to start to lose money. This is not great. I mean, a 10-point move on a SPY that's trading at 468, 2%. I mean, not that it'll happen Monday, but 2% up days can happen in 1 to 2 days regularly, right? You can see recently, obviously, it would have blown right past it in just a day or two, but we've got 42 days to expiration. So the odds of it breaching are actually pretty significant. And that's why recently, in the last 12 years, we can clearly see a situation where the premiums are not nearly offsetting the move in the SPY. And this is happening in certain periods more than others. We can see it obviously even more pronounced since the pandemic bottom, we will call it, where the market has seen several periods of success followed by other periods of, violent down moves. And so what ends up happening is the up moves are costing you, right? Every time it happens, you get into a stretch of a few weeks where the market goes up ahead more than you thought, you are going to be buying back those calls. And you're only offsetting it with the easy victories every time it doesn't breach that line. And long term, very, very long term, we saw, according to that data, extremely long term, we saw that it actually works out, right? That's this chart here. Stretched out to 1986, severely benefited from those golden years of systematic short selling where the markets weren't actually that efficient. We can see that it actually worked out. But recently, the market is just far superior to the premium that those calls are bringing in. And so I guess the question people need to ask themselves is, are you the type of person that trades the market we have in front of us and the evidence that we have, or are you the type of person that thinks the market is going to revert back to the 90s and the 2000s? For me personally, and I posted this on Twitter recently, that actually, if you want to succeed long term, you really should trade the market as it is, not how you want it to be. And I understand that the covered calls, we'll get to short vol in a second. The covered calls, it's such a popular strategy, and there's got to be 100 books on Amazon talking about the easy income generating covered call strategy. The problem is, for the last 12 years, it has failed wildly. And that's because there's more sophistication in the market these days. That's on the one side. The second problem is that the premiums are not offsetting how quickly the SPY can recover recently. Right? In the last 12 years, we are seeing a mixture of very strong accelerating periods, buy the dip with a vengeance, and then we're seeing periods of crashes, right? Very quick, sharp crashes. That's a really terrible environment for selling covered calls because you're going to be clipped every time the stocks go up, and there's only going to be 3 or 4 crashes throughout the year where you're going to get those easy wins. So you're just going to repeatedly be buying back your covered calls so you don't lose your underlying shares. That wasn't the case back in the 90s and the 2000s. If you see the market slowly drift upwards, maybe not slow, but 2 to 3%, something like that, that's going to be a great environment for selling covered calls because you're never really going to breach that high side and you're not going to be able to buy back your calls at a very expensive price. Is that the market? I mean, I'm not here to tell you what you should think about the forward movement of the market, but I can tell you for a fact, since the bottom in 2009, covered calls have not worked at all. Now, I can personally tell you my opinion. I don't think the market's going to return to those days where systematic selling of covered calls would have any expectation of profit. I've always said that I started my trading career basically in roughly 2007. 2005, I was a full-time trader, but 2007, I really got going. 2010, 2011 is when I was thinking about doing this, for a living, as far as a business goes. And consistently, that whole time, I've been saying, look, I don't think that systematic selling should lead in itself to any profit at all. I always say that if you just do this and you just sell options, all right, if you just sell covered calls, if you just sell short vol, if you just sell UVXY calls monthly, if you just sell iron condors monthly, your expectation of profit should be 0% minus trade fees. It really should. And in the case of covered calls, index minus fees, right? Because you're tracking the index. That's the expectation. And so I can actually show you 2 other indexes that sort of prove my point here. The first one is the Condor, CNDR, the Iron Condor Index. We can see something very similar happening here. Or if we go back to the 90s, right, obviously in the tail end of the dot-com bubble here, the stock market significantly outpaced, so, understandable. But basically, the Iron Condor Index for the first 20 years of its existence was also significantly outpacing the S&P. But what has happened recently? Well, when we go down to the recent bottom, since the markets have changed and since we've done all this financial engineering that I don't think we're ever going to be able to just reverse and say, wow, that didn't work, let's go back to the old days. It's out of the bag at this point. We just have to ride this out for wherever it's going to take us. But you can see the Iron Condor index here. I've even got a chart of it. You can see it was wildly successful in the 90s, early 2000s. It was doing well. We've got a 12-year period where it hasn't made a dollar. And this is essentially my point. Why would it make a dollar? Why would systematic selling of volatility have any expectation of profit? Isn't the market largely efficient? I mean, my point has always been that the option market, while it's not perfectly efficient, and there are certainly opportunities for large-scale institutions with large amounts of dollars to do certain things that might generate a profit where you and I, as the retail trader, we don't have access to. But I think in general, if we are all going to enter this market, we should all take the assumption that these are fairly efficient markets. I mean, on a balance of probabilities, there's no arbitrage there. They're efficiently priced markets. And the BXMD index in the last 12 years shows that. The Iron Condor index in the last 12 years shows that. Another index that you can go on, the SIBO short vol index, basically the same thing. What are we looking at here? Well, as we know, shorting volatility can go through stretches of incredible performance, and then it can go through stretches of massive failure. But why would systematic short vol selling have any expectation of profit? It wouldn't. I mean, I understand on Twitter, you see a lot of people who say that all you have to do is just short it, with your eyes closed and you're going to make a whole bunch of money. Obviously, they can just point to a simple chart of the UVXY and they can say, well, gee, all you had to do was just sell calls on this and you would have made a fortune. No, that's just what people say on Twitter. That's not at all how it plays out in actual live trading. Because what ends up happening with short vol, it's very similar to the Iron Condor, just not quite on the large scale, where you get a lot of easy wins and then you get some big losses. And the big losses will actually long-term be offsetting those wins. So you've got an Iron Condor index that's bouncing around like this. If you change this Iron Condor to short vol, it would just be a bigger up and down. It would just be a lot of ups and then a lot of massive or a few large downs. And eventually, every single time there's a crash, it should, if it's an efficient market, it should get very close to the underlying index again. And then it's going to go on a nice little run. And then eventually over here, it's going to see a crash and it's going to come right back down and touch that S&P. There is no reason to expect that systematic short selling would ever make a profit beyond a benchmark. That's not how the options markets are priced. This is what I often tell people, that I get it. UVXY goes down. We all know that. But that's the problem. We all know that. So it's all priced into the options already. You can't just go in and sell UVXY calls and make money. That doesn't work. You'll have 10 or 12 weeks in a row where it works great. You'll think you're a genius. And then you'll have 1-2 day stretch where you're like, wow, I kind of thought that would happen, but look at how badly I lost all my profit from the previous 12 weeks. That's how it happens. There's no reason to think that any of these things, covered call selling, Iron Condor selling, short vol selling, there's no reason to think there's any edge. We have to find our own edge and apply it to the market. So if you own the SPY, if you own whatever you own, Apple shares, if somebody tries to tell you that, hey, all you got to do is just on a monthly time schedule, just collect those revenue, just bring in the income. It's easy money. You're going to hold the shares anyway. Doesn't matter, right? You're not going to sell your underlying shares. Why not rent it out and get paid, right? It's like owning an investment property. Of course, the profit comes in if you rent it out to other people. Just doesn't work. There's just no reason to do that. You would be better off. Now, I'm not a buy and hold investor. I would never tell you you'd be better off to buy and hold. That's a bad solution to an investing problem of low returns because it's the same thing. It'll do well for a while and then it'll crash 60% at some point and you'll be right back to where you started. But buy and hold is actually better than a systematic covered call like a buy right strategy. It just is. Now, the only way that I would be able to change my mind is if enough time in the market passed and we had enough evidence to show that actually we have returned to sort of a 1990s level of market on both sides. One, unsophisticated, far fewer people understanding options. I don't think that's ever going to happen. I mean, every year it's just options are growing and growing and becoming more sophisticated. Now we're competing against, Wharton and Harvard graduates. That's your competition. PhDs in mathematics and engineering. That's who you're competing against in the option market. Systematic selling, come on, that's just not going to work. It's not going to work on vol either. We have to find our own edge and apply that to the market. And that is the point of why I said covered calls specifically, but applying to all option trading, there is no edge. And I've been repeating this over and over. There is no structural edge for option traders to blindly do anything. Doesn't matter if you're doing butterflies or condors or calendars or whatever you do. The edge comes from us, an informational edge. Do you know more than that Wharton graduate that has a PhD in mathematics or physics or whatever? Do you understand volatility products more? If we pull up, our good old VixCentral.com, can you speak intelligently on what you're looking at right now, more so than the people you're competing against in the options market? Do you know what the roll yield is? Do you know what the VX30 is? Do you understand history of the way that volatility moves around? Do you have a dashboard of metrics that help you make better decisions and better entries and exits? These are the types of things that we need. Do you have a positional edge where you are actually able to design a portfolio of different strategies with different correlations and expectations? These are all edges that I have been applying to my trading to beat the problem, and it is a very real, very obvious problem that there is no edge in doing anything anymore. Markets are far too efficient for that. So selling covered calls, that's why it's a bad strategy. It's a bad strategy because here today in November 2021, those premiums don't nearly entice me enough to sell against my shares. I would rather, in my trend following strategies, I would rather just ride the trend. I don't want to keep buying back those calls and only really get paid $3. We can go look at the numbers if you want. What is this actually paying us to hold? This trade that we built, $3 on a 467 stock. If it goes perfectly, right, for 42 days, we are going to make 0.64% return, additional above and beyond the S&P, and that's only if it doesn't go above 477. So best case scenario, 42 days from now, if it goes perfectly, I can add 0.6% to my trade. But if it goes badly and the S&P 500 is up 5% or 7 or 8% in some type of Christmas rally, Santa Claus rally as they call it, well, you're going to be paying all of that money. So this tiny little sliver that I'm looking at here, this is the risk reduction. Covered calls don't reduce your risk. If the S&P goes down, you lose almost as much money as everybody else. If it goes down 50 points and you are holding it, well, the covered call gives you $3 back. So instead of losing 50 points on the SPY, you're going to lose 47. Yeah, technically you could say that it's a risk reduction, but anybody who says that selling covered calls reduces the risk, I don't think they fully understand what risk means. We're talking about the S&P 500 that every 10 years will probably drop 1,000 points, but certainly dropping 300 or 400 is very run-of-the-mill. So if it drops 300 points, oh, sorry, you were staring at me that whole time. I do that sometimes. This little sliver is the risk reduction that I was talking about. If the S&P drops 300 points, you're going to lose 297 of that 300 points. You've not reduced your risk at all. So don't view covered calls as a risk reduction. And also, in this day and age, in 2021, don't view it as an income generating thing because very often you're going to be buying back those calls at a worse price. So this is not a slow-moving, trickle-up type of market. This is for well over a decade now. It has been staggering by the dips, followed by very quick, sharp crashes. And ask yourself, do you see that changing? I don't. I personally don't. At least not for now. I mean, I'm not going to start doing covered calls tomorrow. If we go through 5 years of just pure stability, then I'll change my mind. Absolutely. I'm always willing to say, okay, the market we have here is best suited for insert whatever, butterflies. The market we have now, covered calls are awful. It's a terrible covered, and has been for 12 years. So now what I want to get to is, did I just contradict myself? Did I just say all of that spiel and convince you that covered calls are terrible, only to tell you that I actually have one strategy that sells covered calls, and I have another strategy that you could make a case that might be selling covered calls? Did I just contradict myself? Well, spoiler alert, no, but let's get into the exception with the Wheel of Fun. So, excuse me, a little bit of coffee here. I'm getting excited talking about options. I go on these side tangents. The Wheel of Fun strategy. Essentially, what this is my live streams. We don't ever, promote anything else. But of course, I do have a business and a private community. And in the VTS options side of the community, which will be coming back with, hopefully live streams every week quite soon. So stay tuned for that. But we have a strategy that I call the Wheel of Fun. Now, what the Wheel of Fun is, if you imagine, after I explain it, you'll know why it's a Wheel of Fun. You have cash. You sell an out-of-the-money put. Maybe I can show this a little bit better with an actual example. So let's take Apple stock. Okay? We are going to start this trade. We're going to initiate the Wheel of Fun by selling 42 days to expiration. We will sell an out-of-the-money put option, okay? So we're going to do this. We're going to start the trade right there, selling an out-of-the-money put option. Let's just say, for the sake of argument, in this example, obviously Apple is at a very high price right now. I only do the Wheel of Fun initiating when the prices are beaten down, when the stocks are really kind of looking ugly. You'll never get the tops and bottoms of anything, but kind of starting about here, I probably would have targeted this. Now, Apple is a very high dollar, so we don't do Apple in the community. But the point is, I would never open one right here. I would probably be much more likely to open the put here. But just for the sake of argument, we start this with a short put option. Now, we get paid no matter what happens. This premium is ours, $1.20, and Apple is trading at $1.50. So we're talking about a decent 1.5 month little dividend, we'll call it, of about 0.8% or something. Do this 12 times a year, it adds a little bit of income. Now, again, we're on the put side, not the call side, so two things can happen. It can either expire below. At that point, we would get assigned the shares. If it expires above the strike price that we sold, $1.40, we don't do anything. We keep the premium, the option expires worthless, and nothing happens. We're in cash. So that's the first stage of the wheel. We initiate by selling a put. If it expires up here, great. We had a winning trade and we keep our money and we go look for a new target. If it expires down here, this means we now own Apple shares at $1.40. All right. Now, our cost basis would be $1.39-ish because we did get that premium, but we now hold Apple for $1.39. So what I then do is I go to the next stage of the Wheel of Fun, which is selling a covered call. And what the goal here, let's assume at this point, we are now holding Apple shares at $1.39. Now we want to sell a covered call, right? So that's going to bring in some more premium. Now the difference, and this is a very big difference, that the reason I say I did not contradict myself, I'm actually trying to get rid of the shares, right? The Wheel of Fun strategy has nothing to do with capital appreciation of Apple stock. It is simply capturing premium on both sides of a trade, or maybe just the first side on the puts. You can just keep hammering the puts, and I can go 6-8 months sometimes without ever getting assigned anything, and you just get that monthly sort of put premium bringing in. When you do get assigned the shares, you move on to the stage of the wheel where now you're trying to sell covered calls. The difference being, I'm never going to buy the call back. I'm never going to worry about losing my shares. And importantly, if we look at that first SPY position, where I said it's basically collecting peanuts, right? Collecting $3 on a $467 underlying ETF, that's really not very much. But that's because we have to sell a 30 or 40 delta call option so that we don't lose this underlying contract. Remember, the BXMD index is going to be selling this, right? They're selling way out, so you're not getting anything. If you were to sell at the money, well, now you're talking. Now you can get $8 instead of, $2 or $3. That's the wheel of fun, where what I'm actually doing, I'm not going to turn around and sell a 30 delta or a way out of the money for $1. I'm going to go right at the money, or actually sometimes maybe even in the money. And we're going to try to get that premium as high as possible and not worry about the underlying stock. I don't care about Apple price appreciation. This is a trade that's trying to collect premium only. And the purpose of the covered call is to just get $4 or $5 as I'm getting kicked out the door. That is completely different. I don't even consider that a covered call, because I don't consider the underlying Apple shares to be something I care about, right? It's not a position. I'm not a buy and hold investor that's hoping that I now make money holding Apple. It's never about Apple stock. It is just finding a target. I don't care what the name of it is. Sometimes I trade American Eagle Outfitters. I don't know what their balance sheet looks like. I don't really care. I'm looking for something that has a good pattern of volatility being elevated to the point where I'm getting good premium to potentially own it. And if I do get assigned, hopefully it's a volatile underline that those covered calls sold at the money or in the money can pay me a very large premium as well. And the addition of the put premium initially and the call premium on the way out the door, that's the profit of the strategy. So that's why I call it the wheel of fun, because you start in cash, you go to selling the puts. If you get assigned, you go to the covered calls. And then if your covered call gets assigned, which it probably will because I'm being aggressive and I'm trying to actually get rid of the shares, then you get kicked out of the trade, you lose your shares, and you're back to the beginning. So you go around this wheel, right? And it works in reverse on the call side as well. If stocks are very overvalued, you can initiate your short call option, right? Naked call option. If you get assigned, you will now be short the stock. You go to step 2, you start selling covered puts, and you can go around the wheel that way as well. So you can do this technically if you're good at it, and if you're a good option trader. You could start initiating. Obviously, you can't pick tops and bottoms, so full disclaimer, I'm not saying that we have any crystal ball or anything. But the target essentially is when volatility is elevated on a downslide, you start with your puts. You initiate a wheel of fun on the put side. If, for example, it rages higher, the odds of it continuing that high unabated are probably pretty slim. So you can start initiating your wheel of fun on the call side, doing covered put options on a short stock at that point. Both work just fine. Both collect nice premiums as long as the underlying isn't priced at 150, because that would be expensive, and as long as there's some volatility here. So that's why I can comfortably say that this is the VTS options community, this is the VTS trend following strategies. All of our strategies pick up the trend, and we are hoping that we just hold this position and make a bunch of money holding and following these trends. All right. And the only thing that kicks us out of the trade is if volatility markets, if my dashboard actually tells me that risk is elevated and there's a reason to get out of those trades. Essentially, am I showing the screen share? Yes. Okay, apologies. I hate when I make that mistake. Ideally, we've held these positions. So this is the leveraged portfolio, essentially. We've held these positions for a while. Like this QLD position is up, 25% since it was initiated just a few weeks ago, a month ago. MVV is up 20%. This is what we're trying to do. I'm not trying to lose those holdings. Let's do the QLD. The only thing that's going to kick me out of this QLD position is if volatility markets change. I'm not going to be selling covered calls on this stretch here or this stretch here or any of these violent stretches. That's just going to make me buy the call back at a much worse price, and I'm going to lose my profit. So in my trend following, there's nothing that would make me sell a covered call on these positions, at least not in 2021. Not since 2006 would I even have considered that. But I'm just going to hold these. And yes, technically the SSO, and if we go down to the unleveraged, if obviously MDY and SPY, QQQ, they all have options. We could sell covered calls if we wanted, but I wouldn't want to do that. The performance of our strategies would be significantly worse. We wouldn't be able to, we're not reducing the risk. That's essentially the problem, is that option trading is a risk management tool. Selling covered calls doesn't reduce any risk, does it? It just brings in $3 on a $400 ETF. There's no risk reduction. So within the VTS options community, I do sell covered calls on those positions, like I said, but I'm just trying to get rid of the shares. I don't even care if it's well in the money and I take a loss on the shares. It doesn't matter. I'm just adding up the premium and seeing how much that brings in. And the third point that I would make really quickly here before we move on to the Q&A, which everybody has questions, the VXX. So right now we didn't sell a VXX put option, but sometimes I do. Short dated, 1 week out. But we also have a long dated VXX put option, right? That position is actually 133 days to expiration. It is this one, the 30 put option. There it is there. This is what it looks like. So as long as the VXX continues down, everything's fine. This trend will hold and we're good to go. But what I also sometimes do is on a weekly schedule, I might actually just jump in and try to scalp a little bit of money on a short VXX put option. So the question that came in that prompts this, did you contradict yourself type of thing is, technically, even though I'm using options here, this is stock replacement. I consider this a short VXX position. I just prefer to do it through options so that the risk is significantly limited and it's just a much better risk reward profile. But when you're holding something on the short side and then you're selling put options against it, that is the same thing as holding long shares and selling a call option. Shorting a stock and selling put options is called a covered put, and it's the exact same thing as a covered call. The reason that this is totally different, of course, is these are not the same strategy whatsoever. So the long-term short VXX position, this position has 130 days or more to expiration, and it's just stock replacement. The short-dated vol trend strategy trades sometimes anywhere from 3 to maybe 8 day cycles on the put side of things, has nothing to do with the other strategy. So this is not married in any way, shape, or form with the tactical volatility. These can both make money at the same time. I mean, it sounds contradictory, right? You've got a short VXX position here, and then I've got a short VXX put sometimes here. They can both make money. They don't balance each other out. That's not how it's done. But the vol trend itself is there to offset the rest of the portfolio, where we've got 4 of our strategies that are net long the market, right? This one's net short vol, but these are all net long the S&P. And then the vol trend is just there to reduce the risk a little bit. So again, I don't want to say that I don't care about profit and loss. I certainly do long term, but medium to short term, the vol trend strategy is actually designed to decouple from the rest of the portfolio. And yes, if necessary, lose a little bit of money so that the other 4 can make a bunch of money. That's the whole point. So that is not a covered put strategy. I realize that structurally, you might think that it's a quasi covered put. It's completely not. One of them doesn't expire for 4 months, and I'm just going to hold it indefinitely until I get kicked out due to option or volatility metrics. And then the other one is a pure short-term counterbalance to what I'm doing in the rest of the portfolio. So, yeah, totally not. But those are the 3 points that I wanted to cover where, yeah, that old covered call strategy gets a lot of love, gets a lot of marketing. A lot of people talk about it. Doesn't work. I'm sorry. Systematic selling of volatility in any way has no expectation of profit. When we look at something like the VXX, for example, I understand you can go on Twitter and you can find tons of people who will tell you that, look, the chart is just diabolical, right? It's just the thing just goes down. It goes down 2% every week. That's the average long term for UVXY. All you got to do is just sell those calls, right? Just repeatedly, and you're just collecting pennies. I'm sorry to say, it just doesn't work that way. This is what live trading shorting vol would actually look like in a real daily balanced account over the last 3 years. Notice how this looks a whole lot different than what the VXX looks like here. That's because every time these things spike, you lose far more money than you make on the down periods. Those are extremely punishing, those down periods. And you don't just return to the same point when it happens like that. When you're a systematic short vol trader and you don't really have an edge beyond, hey, I think this is going to happen, if it's just personal opinion, this is what it ends up looking like. You'll have a year on Twitter where you're a rock star, and then you're just going to lose it all, and you're going to go right back to the beginning. And those down periods, you can see that this is the VXX essentially on a rolling performance basis. This is what it looks like. Terrible, right? Again, this is what it looks like. That's the same picture. It's just, I just track it myself. This is what short vol looks like. It doesn't look like this. This is just the picture you'll see people post on Twitter. But actually turning this chart, this terrible thing that it looks on the surface like all you're supposed to do is short it, turning this thing into profit is very, very high level stuff. I cannot tell you how easy it is once you get into trading volatility to turn this and to just start shorting it very quickly into this, very, very quickly into that. That's what happens. It's essentially the difference between Twitter and the real world. In the real world, you actually have to post performance. You actually have to find ways to take something and apply it to make a profit. Everyone in the world knows VXX goes down. Everybody. There's no edge to knowing that information. I'm sorry, if you just learned about the VIX futures and contango and roll yield, you might think you've got this edge. You don't. You don't. Thousands of high-level institutional traders have known that for a decade. That is not an edge. So the problem with Twitter, and I always rant on Twitter because I can't stand watching these traders post charts of VXX and UVXY and say, oh, all you got to do is short it. Look at all the money I made. Did you? Because you didn't post the money you made. You posted the chart of VXX. Something that goes like this, and then you just tell everybody you're a short vol trader, their brain's going to put two and two together, and they're going to draw that comparison for you. They're going to say, oh, he must have made a whole bunch of money because I can see the chart, and he shorted that chart, and wow, he must have made a fortune. But when you actually turn it into a real strategy, very quickly it's a losing trade. And the vast majority of the people that you see posting their short vol charts and, hey, this is the only idiots go long vol and only the smart people go short vol, all the stuff that you see, that doesn't translate into profit for anybody. So long vol, short vol, equally potential for profit. Covered calls, no potential over the benchmark. Selling iron condors systematically, no potential for profit there. Selling short vol, there's nothing there. You need to find your edge. And I'm not telling you all this to say, hey, don't even trade. There's nothing. There is. You can be better than those people you're competing against. But it's a competition, and they're smart. So don't think that just because we have a few tidbits of knowledge that we can jump in there and do it. It's not how it works. Hopefully I have sufficiently explained why selling covered calls has not worked for 12 years and, in my opinion, won't ever work again because of the general efficiency of the options market. And short vol, while it certainly had a glorious period in 2016 and 2017, I mean, look at that. Just beautiful. For the most part, this is what short vol looks like. Losses are far more costly than gains are beneficial. If you make 50% this year and you lose 50% next year, you're down 25%. It does not get you back to break even. That is the simple math of it that oftentimes people forget to mention. So there you go. Let's move on. Hope I didn't ruffle too many feathers there. I understand. People love covered calls. They love it. They love selling iron condors every month for income, they say. I'm sorry. All those books that you bought on Amazon, they're outdated. That stuff doesn't work anymore. Hasn't for a long time. Okay, number 2, hot off the press. Typically, or eventually, I'm going to have little segments and stuff. This is going to be a more organized show, so bear with me. But segment number 2, hot off the press, I am just going to highlight what I've done recently with the new Clips channel. So what the Clips channel is I don't want to clutter the main YouTube channel with everything that that we're doing with the live streams. So what I've been doing is I've just basically been chopping up all of the questions individually and little segments. Like obviously this was a rant, a long rant, but you can see a minute 39, 4 minutes, 3 minutes, 3 minutes. These are just, there's another rant about hedge funds. Sometimes I go on those. Did a couple on the pandemic and whatnot, but mostly we're talking about like 4 minutes, 1 minute, 5 minutes, just little things, right? Little questions that you guys ask that I can just upload one every single day. So that's what the Clips channel is going to be. Now, I would appreciate it. I can't, beyond just asking, I hate to ask, but I would appreciate if you guys would subscribe to that Clips channel as well. If you're a member of the VTS community, they're included in every daily email. If you follow me on Twitter, it's at VolatilityVix. I post every single day on Twitter as well. I'll post videos, live streams, articles, whatnot. But go ahead and subscribe to the Clips channel as well. Should have had an easy way to do this. I wonder if I drag a link. Let me try something here. Bear with me. Here, I'm gonna let you watch me do this because I don't know if it's gonna work. Live with Restream. No, you're not there. You guys are here. I am going to drag this link, and we're gonna just see what happens here. We're gonna do this live on camera. Oh, that's why. See, I'm logged in with my Clips. That's what I did today. Okay, let's see. Now, I don't know. I don't know what that's going to look like. I don't know if you have to drag it and copy and paste or whether that's a clickable link. I have no idea. But yeah, if you would be so kind, subscribe to the Clips channel as well, and you're going to get all of these little questions chopped up. But let's actually get into the Q&A section. That's why a lot of you are here. But dissuading you from wasting your money selling covered calls, I think, was time well spent. So thanks for listening to that long rant. There are a myriad of ways to make profit in the options world. I did not mean to give people the impression that they can't do it. My only point is this is a fierce competition, and you need to be at the top of your game if you're going to make money in these markets. I used to be a professional golfer. When I was competing in golf, it would be completely silly for somebody who sort of has only been golfing for a couple of years, doesn't really take it very seriously, for that person to come into the tournaments that I'm playing and expect to make money. I would just look at them and be like, what are you doing here? Like you can't even break 80. Why are you here? Right? That's what it looks like. I don't mean to say this in a rude, condescending way, but I have been trading options for 17 years now. When I look at the level of knowledge that I see on Twitter, it's the same comment. I'm like, what are you doing here? You're competing against us, and us meaning, institutions, and I'm even trying to, outperform them and looking at them like, wow, that's impressive. You are a math PhD from, Wharton or Harvard. I'm going to have to really study and really work on this 10 hours a day for the next 5 years in order to be able to be on your level. That's how I look at it. I look at all these people coming into the options world. Oh, all you do is just sell UVXY calls. Really? That's all you do. So how come you haven't been doing that for 15 years? You were working a regular job and you just stumbled on short vol 2 years ago. That's not how it works. It's the same as the person who can't break 80 trying to compete against professional golfers. It's not going to work. If you think that you can just buy a book on Amazon and sell covered calls and generate premium on your SPY, it just doesn't work that way. I'm sorry. I don't want to say that too condescendingly. I don't want to discourage people, but this is a fierce competition. Investing is very hard, and you can't just do this and sell iron condors. That does not work. Hasn't worked in 15 years. So I think there's some lessons in here today. Hopefully, some of you are going to hear my warnings, are going to hear my sort of borderline insulting comments to a lot of the traders out there. And instead of being discouraged, because you could get discouraged. What I just said, because you're watching this stream, you probably haven't studied for 10 years. You probably haven't been trading. You could just go away and you could just say, yeah, you know what? He's probably right. All of those option traders, they know more than me. But some of you out there are going to roll up your sleeves and do the work, and it's going to pay off. So I don't want to give you the impression like I'm not sending everybody running for the hills. There are certain among you watching my live stream that over the next several years, you are going to hone your skills. You're going to learn what you need to do. You're going to jump in that fierce competition against all those super smart people, the smartest minds on Wall Street, and you're going to find a way to make money in that market. Most of you are not. But the problem is, a lot of the people that aren't, they have been convinced that they can by reading Twitter comments, books that were written 15 years ago, people who teach but don't do. There's all kind. I mean, trading communities, all these things that we're just hearing waves and waves of people getting taken down by the SEC and all this stuff. They're being convinced that it's easier than it is. There is no way to get around it. If you want to make money trading options, you have to be one of the smartest people in the options world. If you want to lose weight, you got to go to the gym and eat well. If you want to be a pro golfer, you got to hit the golf course for a decade. There's no getting around it. So obviously systematic anything is, I know it's romantic to think that you can just do something simple and money falls from the sky, but it doesn't work that way. Okay, rant over. I feel like that was a good one. When I go back and edit, there'll be some funny clips there. I'll be like, did I really say that? I shouldn't have said that. That's aggressive. Oh, I shouldn't have said it that way. Okay. You're saying covered calls against SPY is a bad idea because it doesn't reduce the downside risk, as we don't know how high the SPY can go, but we are capping our gains. Yes, capping your gains, you're not reducing your downside risk. Good. Let's move on. We can say the exact same thing about the vol trend. I think I went into this, but I'll finish. Where we sell VXX puts against SVXY, though. True. Selling VXX puts also does not reduce the downside risk, as we don't know how low. Yeah, true. I'm not going to go into this too much because I think I nailed it, and you probably asked this at the beginning of the stream rather than later on. But yes, absolutely, the vol trend and the tactical vol have nothing to do with each other. They're completely unrelated, and in fact, it oftentimes pit against each other. So, yeah, it's just a completely different thing. It's not a covered put strategy whatsoever. I don't understand how you can have such great performance, but 90% of hedge funds don't beat the market returns long term. Why don't you give billions for your strategy? I intend to do a full video on that. I don't want to just I want to do it justice because this is a very good question. And it actually comes back to what I just said. This is a highly competitive industry. And in order to make money, you really do have to know what you're doing. Like, you can't be a part-time lawyer. You can't be a doctor on Saturday and Sunday. These are professions that you need to be smart and studied and experienced in order to perform. Nobody's going to let you design a building as an engineer that you only do it an hour after work on weekdays. It just doesn't work that way. Investing is one of the highest money market professions in the world. It attracts all of the smartest people in the world. Those brilliant engineers and mathematicians, they gravitate towards trading because there's money there, to hedge funds. That you've seen those movies, Margin Call, for example, where the guy says he's a literal rocket scientist. And then the boss of the hedge fund says, well, what are you doing here? And he says, well, to paraphrase, he says that, the compensation is considerably more in this industry. That's what we're talking about here. Talking about, this is not easy. You are in a competition with the best people in the world. So it's a very good question. One, structurally, I can be tactical where large funds cannot. And that is a very, very big difference. If you look at my portfolio, we do exit trades when we need to. If volatility metrics elevate, I can get out of my entire portfolio and move into safety within one day. That is not possible when you have the size of the portfolio, billions of dollars and 1,000 different clients. And when you're acting as a custodian for other people's money, you actually have to follow all the regulations and execute all the, it's just a nightmare logistically. So they typically don't have the nimbleness that I do. And that is a very, very big edge that I have. Another thing that I can say that it might sound a little bit, maybe a lot arrogant, hopefully just a little bit arrogant, but it might sound like, oh, I can't believe you said that. But is it possible that I'm good? I mean, is it possible that I am one of, I was a professional golfer for 20 years. I was in, I had a Sony World ranking. I was one of the top players. I won the qualifying school. I was a top player in Canada. I was on my way. I had a bunch of injuries and I didn't end up making it. But how does that happen? A kid grows up in Canada, it snows 6 months a year. I basically started when I was 15 years old. I couldn't break 100 when I was 15. I broke 100, worked really, really hard my first year, and I was down to scratch golfer within 2 years. But that doesn't happen without just ridiculous levels of work ethic. I mean, I'm sure there's some talent in me somewhere physically. I was always, the best on the team and, hockey and soccer and all the sports that I played when I was young. I have some athletic ability, but mostly it's just work ethic. And it's the same thing with my investing. Now that I've moved away from pro golf, I was certainly in the top 0.001% of golfers in the world. I never asked myself the question, well, what gives you the right to think that you can compete with all these other pros? My answer is, watch me. I'll do it. I'll put in the work. Give me 10 years. I'll get there. So it might be a laughable question when I was 16 years old. Oh, really? You're going to be a pro golfer? Come on. You grew up in the snow. That's not going to happen. Give me 10 years. Give me 10 hours a day. I'll get there. Investing's the same. I started in 2005. Is it possible that I just put 17 years of 10-hour days together and never took a day off once in my life? Is it possible that the reason that I beat 90% of hedge funds is because maybe I am in the top 10%, top 1%, top 0.1%? Again, I don't want to sound too arrogant, but that's an aspect, certainly. I guarantee you that nobody outworks me. I'm sure there are people that work as hard, but does anybody really sacrifice what I do for this industry? I don't know. What are other reasons? I should probably dedicate a full video to that, but yeah, I crush most hedge funds. Now, sure, you could probably point to some that are better. I don't know them. Like obviously somebody's going to say Medallion or, whatever, insert whoever you think. And that's great. They are also in the top 1% or 0.1% or wherever you want to rank those people. Yeah, somebody has to be the bottom 1%. Somebody has to be at the 50th percentile. Somebody has to be in the top. I'm proud of the 17 years I've put into this job, and it's a passion of mine, and my work ethic reflects that. So I have no doubt I will continue performing well, because if you golf 10 hours a day for 10 years, you'll be pretty darn good at golf. If you do what I do in investing, I guarantee you'll be pretty great at volatility trading if you put in the time that I have. You'll understand, and you'll look at the options market and you'll think, yeah, they're smart. They're the best on Wall Street, but why can't I be as well, right? Give me 10 years. I'll get there. And now I am. I started in 2005. I didn't know a whole lot back then, but I did my work. That's the one thing that in my life has always served me well, is when things need to be done, I just do the work, and I don't mind. I enjoy the process of building. I'm always building and competing against myself, and investing's the same. I wasn't always this consistent. I have videos on YouTube showing that I have my periods of losses as well in the past. It's just that was 10 years ago. Hopefully I'm better now. Earlier in the year, you mentioned starting VTS options towards the end of the year. Any update? Yeah, I've just been swamped, to be honest. I haven't really dove into that much yet, but I think I'm going to do the same thing. I'm going to kick it down the road a few months and tell you it's coming. It is coming. Options trading is awesome. It's a great way to make money. I do have a lot of experience in that area, and it's fun. It's more fun than what we do at VTS. but I need time to do it right again. The community was great before. There was a lot of people on it. I just shut it down for a while. There was a good 600-700 people following, but I want to make it better. What do you think about commodity spread trading? I don't really get into commodities too much. Honestly, though, what I could say is the underlying itself doesn't really matter that much to me. So sometimes people say, well, do you trade this asset class or that one? I mean, no, but it doesn't matter to me. It's just the same fundamentals apply. And in fact, just to stretch it to a bizarre level, the same fundamentals of golf apply to trading as well. It's really just work ethic, studying the underlying, figuring out what works, doing more of that, figuring out what doesn't work, do less of that. Long-term trial and error, eventually you get good at it. So it's all the same to me. I just don't happen to do that because permissions-wise, we don't trade futures within the VTS community. It just adds another level of understanding and regulations and brokers' approval and all that. So we stick to the basics, ETFs, options, and that's it. I don't trade gold. I don't yet trade Bitcoin, but now that there are actually potentially ways to do that, hey, who knows? Maybe I need to get into the crypto space. I'm negative long-term on just, I don't want to get into it. I'm not anti-Bitcoin. I'm just, I'm anti-everything bubble, and Bitcoin seems to be no different than real estate. I mean, if I said, hey, I'm not sure this real estate market's going to continue going upward, guys, nobody's going to say anything. Everybody's going to be like, oh, yeah, that's fine. I totally agree. It's at super high prices. It went way too far, way too fast. It's got to pull back. Nobody's going to bat an eye. But the second I say, you know what, Bitcoin, it's gone way too far, way too fast, or NFTs, I don't know about this market in the future, guys. Now all of a sudden I'm enemy number one. I've said something, blasphemous against the community. I don't understand it. I'm against the everything bubble. Everything is overvalued right now. Real estate, equities, Bitcoin, NFT market, all of it. Does that mean it's going to crash? No, absolutely not. This could go for years. Who knows? That's what I do every day, is try to just balance the risk and make sure. But for some reason, when you say something negative about Bitcoin, all rationality goes out the window, and now all of a sudden I'm a hater and good, have fun staying poor. I don't know. Okay, I guess I'm poor and I'll have fun doing it. I've been poor in my life. I had plenty of fun when I was poor. So yeah, I missed out on Bitcoin. Doesn't affect my life. Unless you get assigned, I feel like I might have missed an initial. No. Unless you get assigned and stock keeps going lower, so you break even, call is way out of the money and worthless. Unless you get assigned and stock keeps going lower, so you break even, call is way out of the money. Oh. Yeah. I think, again, I touched on that before. This is a question that was asked at the beginning of the stream. It's cool to hear that there's someone telling it like it is. It is certainly not for everyone. Thank you. Passion, thank you. I do enjoy what I do. And like I said, I do tell it like it is. I am very honest. And I know there are people who are going to hear me speak who turn it off. They don't want to listen. But there is going to be some among you that have the same work ethic and desire to succeed that are going to say, you know what, challenge accepted. I'm going to actually start doing this correctly. I'm going to turn off Twitter. I'm going to stop following those people that paint it as this, oh, I make 30% a year. I'm a full-time trader. No, you're not. You work at Costco or whatever you do. You're just on Twitter. I have a very negative opinion on people who talk about anything that's easy. If somebody... Take investing out of it. It's like the Bitcoin thing. You say something negative about Bitcoin, you're the enemy. You say something negative about real estate, 80% of people say, I agree. It's the same reason. It's the same thing. And investing's the same as any other profession. I'm not against other full-time traders. I'd be against somebody who was a lawyer and who was talking about how it's the easiest thing in the world. And guys, like I walk into the courtroom, I put my briefcase down, I say my opening statement, and boom, case won. Anybody who said that, they'd be laughed out of the room. That is not how the legal system works. You have to know every little intricacy about it. And if you don't, then the prosecutor or the defense, whichever side you're on, they're going to find some loophole. They're going to expose your weaknesses, and they're going to win the case against you. So I'd be just as against somebody on Twitter who was talking about how a triple bypass surgery is the easiest thing in the world, and all you got to do is just snip, snip, and it's done. Okay, you're not a medical professional. That's what I would say to them. And if anybody pretends that trading is easy and you're going to make 40% a year like clockwork, just tune those people out. No, you're not a real trader. You have no experience. If that's your opinion of the market, that you're dead. You've already lost. Just don't know it yet. You're just on a run where, I'm sorry to say, unfortunately, you are just leveraged long beta to the S&P 500. That is all your trading prowess. Not you, but the proverbial you, the Twitter people who say this is just easy stuff. It is just the product of leveraged long beta to the S&P. That's all it is. I mean, honestly, when this type of thing starts to happen, all of a sudden, things get interesting pretty quickly, and you start to realize a lot of people who thought they had skill actually didn't. They were just leveraged long. And a lot of people who looked like maybe they were a little too conservative, maybe they didn't make 50% on the run up, all of a sudden, long term, they start looking very good. They start looking like the responsible traders in the room. So don't think my rants against the Twitter traders is against traders, right? It's against everybody who pretends that a serious profession is easy. Anybody who fronts that being a pro golfer is easy, you do it. I sacrificed plenty in my life to make that a reality. Anybody who thinks trading's easy, try it. Show me your track record. Anybody who thinks doing surgery is easy, it is not. You are competing against all the smartest doctors in the world. Professions are professions for a reason. So I don't mean to be negative and discourage anybody, but this is real stuff. It's hard. All right, what's your advice to someone closing in on 1 million investment account for the first time? First part of that, congratulations. The second part of that, I don't like for the first time part. For the only time, right? Like, that's just it. And there's just going to be once and once only, right? My advice to you would be the advice that I would give everybody. Long-term, with a super high focus on risk management is the only way to succeed long-term. Now, I get it if somebody has a small account, they have $5,000 or $10,000, and for some reason they have this instinct when they have small amounts of money to just, hey, let's just risk it. Who cares if I lose it? Let's just go big. Even for those people, what I recommend is target your 12-ish% a year for the next 30 years. Learn how to do that, and you will be a mega millionaire. Learn to make 12% a year for the rest of your life with very manageable drawdowns and very low risk. Learning the skills to watch the market go up 30% and you're only up 10, but then watch the market go down 50 and you're also up 10. Learn those skills now, and for the rest of your life, you're on easy street. It's just, that's how you do it. And I don't care if you have 1 million, congratulations, that's amazing. Very, very few people have that amount of capital. So congratulations on reaching a milestone. It feels good when you get there, and protect it, right? It's your livelihood. Obviously you got there for a reason, probably because you were fairly conservative in risk management. I don't think it happened in the last year. Probably happened over many, many years. And you had to trade through 2018, 2020, 2024, whatever crisis is going to come then. And so for the people who have $5,000 or for the people that have 1 million, it's the same exact method of trading. Learn the good skill once and do that for the rest of your life. Don't do the, hey, I'll be super risky now and eventually I'll learn how to do it when I have some real capital. Why? Why not just do it now when you have $5,000? Learn how to do it. Pay money to pay that skill. Once you have that skill, you're good for the rest of your life. So it's just a rinse repeat type thing. It's kind of like in my golf career, It takes a long time and a lot of practice to be able to, the very first time, stand up on a tee, flat hole, no wind, soft conditions, and crush one, 280 yards down the middle of the fairway. It takes a lot of ability to do that once. But once you do it, it really is just rinse, repeat. You've already done it once. Now you just have to figure out how to manage risk and contain those X factors and just rinse, repeat over and over, and you're good to go. What you don't want to do is on day one, just say, hey, I don't care what I shoot. I'm just going to go for it completely. And eventually I'll learn how to play golf correctly, but not now. Now I'm just going to go big or go home. What's the point of that? It's the same as investing. Doesn't matter what your account size is. It's all the same. Hyper focused on risk management and drawdown reduction, and let time be your biggest ally. 30 years compounding at 12%. You're looking at some serious money there. What do I got here? Calculators. Compound interest calculator. Where are you? I don't know. It's a lot of money. As we know, you can imagine, multi-millionaire. You can go through the exercise yourself. But yeah, that's what I would say. Congratulations, $1 million in your trading account. That's fantastic. And I know you, obviously I think you're much younger than me, so extra congratulations there. And don't do anything stupid, just manage risk, and that is your livelihood. That's, again, tune out the people that tell you you're supposed to be making 30, 40% a year. Make your 12 for the rest of your life. You can't even believe how easy your life's going to be once you learn that consistency. Bitcoin is Tulip Mania 2.0. So Marius here is, now you're with me. Now you're public enemy number one. You have said something negative about the Bitcoin space, and the algorithm hears you, and now you're the target for their ridicule. Just like me, Marius. Have fun staying poor. I like you're saying everybody's a genius in a bull market. It's not mine, but I say it a lot. People have been saying that for years, and it's absolutely true. Look, I get it. A lot of investors probably did pretty decent, right, in the last several years. That's why I said to be short vol in 2021, and if you didn't exit any of your positions at all, if you just said, hey, I don't care about these volatility spikes, I'm just staying the course, probably doing really, really well. Systematic short call sellers on UVXY, probably doing really, really well. What you don't know is that, again, ranting against Twitter traders, they're going to be just all over the platform telling you how incredibly easy it is to make money shorting this thing. It's just, you're just a complete idiot if you don't know to do that, right? Short vol, go big or go home. What they don't realize is that a lot of us were following those same people for the last 3 or 4 years, and a lot of them had to outright leave the platform for several months when the bad things were happening. I don't say any names particularly, but there is one or two of them that it's actually funny to watch them talk about how good they are when I know for sure, and I've actually could show that they were just completely blown up and laughed off the platform for multiple times. So sure, the last year and a half, and I'm sure it's been fun for people who sell that type of message. But again, getting back to this one, ignore that. Try to ignore that. That will end. That positive beta to the S&P being the easy trade, being net short vol the last year and a half being the easy trade, that will end. And when it ends, you want to be the person that doesn't care if it ends. You want to be the person that is able to handle your account, whether this continues indefinitely or whether it ends in a spectacular fiery crash. You want to make sure that you're the type of person that is fairly indifferent to either side of that outcome. I know I am, and I worked very hard to get to that point. I know my portfolio is going to be just fine. If through all the crashes, we're going to be just fine. It doesn't feel good when it's happening, and everybody gets in. When you get into a 5 or 10% drawdown, when you look at it on a chart like this over our 10 years at VTS, you don't even see them. They're just like little blips on the radar. But I promise you, the recent 10% drawdown that we suffered, you feel it. You really do feel it, and it's hard to tune out the negativity out there. But the thing is, the market will at some point stop doing this, and you want to be indifferent to that outcome. You want to have full preparation to know exactly where we're going to be 5, 10 years from now, performance-wise, not 3 months. I don't know what I'm going to do in the next 2 months. Maybe we end the year with a bang. Maybe it goes negative again. I have no idea. But I know for sure where I'm going to be 5 or 10 years from now. So that's the key. Yes, and there are a lot of new ones in the market. That has not usually been a good sign either. Risk of the fixed income market today. I think by new ones, you're talking about these traders who, yeah. I've been trading short vol for a long time. I started in 2010. I actually had a full video showing all my, VXX stuff in 2010. I have actually been doing this for, 10, 12 years with volatility ETPs. Back when, again, not to sound whatever it sounds like, but when my volume was actually not significant, but noticeable, right? Nowadays, it's nothing. But back then, there were very few people trading it. And I've seen the same thing, just waves of new people coming in, right? So 2012 wiped out a whole bunch of the inexperienced ones. It was a tough period from about March to May or June of 2012. Most people don't know that, but that was a very tough short vol period. And then for about a year and a half, it was easy street, right? So we had a wave of new people, and there was a bunch of new websites popping up. And there was, what are the names of those websites? There was one guy who he had 30 or 40 short vol strategies on his website. Just a wave of them popped up. And then August 2014 happened, and it wiped out. Everybody who's using the standard VRP method was basically wiped out because they realized in historical vol, these crossover periods that they were looking for, well, they can both just go up together, and you're going to stay in your trade the entire way down. You have to find volatility metrics that don't actually keep you in the trade during a crash. And if you're just tracking the IV versus HV, sometimes there's a clean crossover where, the IV and the HV signal that the premium has flipped negative, and it's a great signal. But there are other times when the whole thing shifts upwards and you stayed in your trade for a month and lost 80%. So, and then that went away, and then 2015. But of course, 2016, 17, waves of new traders finding this short vol, easy street trade that you just can't believe how easy it is. It's an ATM machine. And then 2018 happens, and those people blow up and they leave Twitter. And then 2019 was a good year. It goes on and on and on. So right now, November 2021, I would say the fake gurus is also at an all-time high. There is a bubble in real estate, there's a bubble in Bitcoin, there's a bubble in the stock market, and there's a bubble in online gurus right now. All of those will pop. So don't be affected when it does. Be that person in the room that honestly doesn't care what happens. You have a plan for everything. Your portfolio is going to be able to weather whatever gets thrown at it. May not always be fun. You might take small losses, but be that guy who's here 20 years from now with a massive account. And just laugh at the nonsense. Laugh at the NFT market. It just, okay. 5 million for a digital, okay. Have fun with that. I don't have $5 million, but I have better things to do with it when I do get $5 million. Do your thing. What else have we got here? Bitcoin mania. I shouldn't have. Once that word Bitcoin just flies out of your mouth, it's over. The comments is just a disaster. Okay. Yeah. Could you go over the process, strikes, and days to expiration of your Wheel of Fun again? I feel like I wouldn't be doing it justice. I don't want to make you stare at my face here while I'm searching for something online, but there might be passwords involved. So just give me a second here. Hopefully this doesn't auto. What I'm essentially going to find here is a video, a full video. It's not public. That's why I'm trying to be a little bit coy here. Apologies. Where's that video? But if you email me, I will send you the private information about the Wheel of Fun strategy. Where are you here? Gains and losses, volatility barometer. Apologies, we're almost there. This is the last page, I think. There's the vol step. Okay, so now I can go back and not do this. So behind the scenes of my YouTube channel, I had to log in and passwords and stuff. But there's one that we called the vol step, and these are all private videos. Welcome back, everyone, for the community. But so if you want to email me, I will actually send you these private links. I don't mind doing that for you guys. Anybody who's watching this stream to the very end, you should be rewarded with something, right? And here's the Wheel of Fun. Again, unlisted, not a public thing, but good video. Welcome to... Look at me back then. Just a gray wall. No ability whatsoever to shoot videos. But I basically went through like the whole Wheel of Fun and why it's called that. How you can do it on the put side just as much as you can do it on the call side. So if you want access to this, for anybody who's watching this stream an hour and 30 minutes into it, you go ahead and email me and I will send you that video for free. Both of those videos for those two strategies. This is a massive question that would require hours, months, years to answer for you. Gets back to the same thing I was ranting about today. Just roll up your sleeves, do the work. Understand that nothing good is going to come with a 5-minute explanation. I'm not picking on you here at all. Great question. How do you even get 12%? The average investor out there gets like 2 to 3. The average hedge fund gets 3 to 4% a year long term. The S&P 500, we can look at it now. A lot of people, they go berserk when I say that the S&P probably won't make 5% the next 20 years. Here's why. I'll show you why. Right here, S&P return calculator. I'm not going to do any cherry picking at all. This is just the last 20 years. Adjust for inflation. It's made 5.2% the last 20 years. And we are at a staggering all-time high, by the way. So that is, it could not be at a better point to be measuring this from. Absolute peak. And to September 2001, honestly, pretty good entry price as well, near the bottom after the dot-com stuff. We could easily make this 1 or 0% by just moving the dates a little bit. But this is just a good time to enter, absolute best time to be at, and it's still only 5. If you reinvest dividends, it's 7. So the real question is, if the S&P 500 is only expected to make 3 to 4, 5% maybe on the high side over the next 20 years, because again, we're starting from a super high point right now, and the market is just terrible right as a setup for long-term success. So let's say it makes 5. Bonds are going to make what, 1 to 2 or 3? How do you make 12% a year? Given that, right? Given the fact that the best and brightest on Wall Street can't do it. So what would make us think we can? Well, I got bad news for you. It's the same way anybody who's struggling with weight is going to do it, by doing it. By just, there's no electrodes you can hook up to your body and zap you every night, and there's no magic pills that you can take. You just got to work out for the next 3 years. 3 times a week. You got to eat 2,000 calories or less all the time. And that's just the way it gets done. And with investing as well, I wish there was a way that I could just say, hey, this is not that hard, guys. Making 12% a year you can do it. I don't know. It's actually really hard. Making 12% a year, it's really, really hard. And very few people do it. It's a number that gets no love on Twitter. If I were to go on Twitter right now with 20,000 Twitter followers and post, I've made, average the 2 portfolios together, I've made, 23% or something a year during this bull market, I'll get laughed at. That people will be like, oh, that's cute. That's adorable. But in the real world, that's the accumulation of 17 years of experience at work. It was not easy to get to that point. So, 12% a year, super hard to do. But you can do it. You can definitely do it, and there are ways to do it. Focusing on risk management. Like I said, losses are more costly than gains are beneficial. Don't lose 40% of your capital, ever. Don't ever suffer massive drawdowns. And then from there, I'm also the product sometimes of positive beta to the S&P. I know that most of the time my portfolio is net long the market, net short vol. 60% of the time, that's my positioning. Well, just as a pure function of how markets work, profit's going to come in. I don't have to worry about making money. I mean, like I showed, maybe I left a little bit on the table recently, but in the last 6 months or something. But honestly, the profit is coming. This strategy is up 25, 20, 20. It's fine. But I'm always focused on avoiding this, right? I just don't want those big drawdowns. I don't want to ride anything down more than 10 or 15%. And when you focus on that, gains don't have to be chased. The fish just jump in the boat. If you're positioned correctly, that just happens. Focus everything you have on trying to mitigate risk. That does not come easy. That's where the real problems happen. So it's probably the key to my success, is that I have a very thick skin when it comes to being able to tune out the crowd and just do my own thing. Probably I have this one segment planned, Lessons from the Links. I make a lot of golf references because it was a major part of my life. I mean, I started golfing when I was 15, and from 15 to 30, 32 years old, 17 years or so, I was just in it, all in, pro golf. So there's a lot of lessons learned there, and yeah, that's one of them. I had to tune out the noise because I didn't have the prettiest swing. I didn't have the flashiest game. I didn't hit it very long. There was a lot of ways that I could have been derailed in that process and just try to be like everybody else. Oh, 300 yards, that's good. Well, I'll make a career making sure I never miss a 3-foot putt. That was my attitude. It's just my putting was off the charts good, and the rest of my game was kind of okay, decent. But yeah, it's flashy. You drove it 300 yards. That's amazing. But this length of putt is the same number of strokes saved as that 300-yard drive. So just don't miss the putts, and you're going to be fine. I'm good enough to hit enough good shots to shoot even par or better. What I don't want to do is make 3 triple bogeys. That's going to make it very difficult for me to get back down to 72 or better. But if I just don't make 3 triple bogeys, well, I mean, I hit enough good shots somewhat near the green, somewhat near the flag. Eventually, I'm going to make a few birdies, and I'm going to shoot under par. As long as I just weed out those ridiculous shots that, oh, shouldn't have done that, and now I lost a ball, and now I'm out of bounds. Eliminate that, and you'd be amazed how easy things appear. It's not easy, but it seems to be easy. My golf game, I went 2 years without losing a ball. That's what I focused on. Never, ever being in trouble. Hit it short and straight, and make all my putts. The rest is just a function of being near the green, right? And it's the same as investing. Eliminate massive drawdowns and don't do anything stupid. The rest of the profit is just a function that the markets mostly go up. Short vol mostly goes down. Target the right area and you're going to be just fine. But very few people can do that. Fund managers, hedge funds, they can't do that. They have numbers to reach. They have people to impress. They have stockholders and whatever it is to, okay, by this date, December 31st, you got to show me something. I don't do that. I don't care what calendar year it is. I don't care that I had a drawdown last month. I don't care if it happens in October 2021 or January 2016. I don't care. I just tune out the noise and do what I do. And you need to do the same. You can get derailed very easily in this investing world. So, lessons from the links. Because just to carry on with this a little bit, you know one thing that I noticed in my golf career? All those people, and there were thousands of them, and media and other players and competitors telling me that I wasn't playing correctly, all of them fell by the wayside. And 10 years later, I'm playing pro tournaments with my little bunt down the fairway and making all my putts. And I'm the one that was playing pro golf. And all those people that were flashy and impressive and just, telling me I'm doing it all wrong, they never made it. And investing, if you're chasing gains short term, if you're trying to impress people in certain calendar years, if you're trying to do what everybody else is doing And if somebody on Twitter says I made 30%, well, I got to go try to make 40. All of those people will fall by the wayside. Bad market periods will take them all out. And you want to be that boring, consistent person that just kept their head down, ignored the noise, and every year for 20 years, there's your name. Not at the top, but there's your name. Maybe you're here, but you're always on the leaderboard. You want to be that guy. Investing's the same. You always want to be moving your name up the leaderboard. If it's only 12%, it's only 12%, but you moved up the leaderboard, and that's good. All right, macro question. When do you expect the bull run to end? Next interest hike? I don't know. I honestly don't know. And I'm sure you're asking because you don't know, and none of us know. Usually I have better answers. But now more than ever, and I should give me more time in future streams, come back and ask similar questions and sort of hone in, because I'm sort of still forming this opinion in the last several months, or certainly the 18 months. But I believe the economy has passed the point of no return, to the point where what we have done in the last 18 months cannot be undone. It cannot be reversed. It's forward until disaster. And I hate to say that, I really do, but I just don't think that there's any incentive anywhere anymore for responsibility. So I believe, to answer your question, if I had to guess, and this is a wild guess, nobody knows. Anybody who says they know, they do not know. Just don't listen to them. My guess is that they're going to be able to keep this train somewhat on the tracks for longer than you think. And then it's going to end so spectacularly that goes far beyond what anybody thought possible. Because when we look at the financial crisis in 2008, that was bad. But they immediately began financial engineering and recovered. 0% of us were around during the Great Depression, right? At least trading. There were people who were still there, but they're, getting carted around the golf course hoping to get their last few rounds in, and good for them. But very few of us even know what that's like beyond just numbers. Oh, it dropped 86%. Okay. It doesn't hit home for us. But what if it does? I think it's going to be when it goes off the tracks, when this train finally just runs out of track, I think it's going to go down so far, so fast, for so long that people are just not even going to understand. And when we're down in the gutter of these markets, the powers that be are going to be they're just going to be experimenting, because they don't know either. So it's just going to be, hopefully the things they try work right away, but there's a pretty good chance it'll look more like the financial crisis, where it crashed big and then they kind of thought, okay, we've got this. And then it came up and then boom, it went really far down to March 2009. I think it's going to be several of that for several years, just false starts. And I think we've got this, and then it's off again. So I think that's our future. Unfortunately, I think responsibility's out the window. The entire world now is propped up by equity prices, both real estate and equities, stocks. They just simply cannot allow those to go down anymore. So they can go down temporarily, and they can certainly be, on a real adjusted basis, they could stagnate or even go down a little bit, but they can't allow it to crash. It just can't. So I think your question is somewhat loaded, like oh no, that's not even the right one. When do you expect the bull? There you go. It's a little bit loaded because I think I'm guessing here, but it sounds like you're probably expecting it soon-ish, within the next year or so. I don't, to be honest. I think they're going to be able to keep this more or less on the tracks for a little while, for several years. And then when it ends, it ends. And like I've been ranting on way too much today, you better hope you are ready for that and you know exactly how to handle it when it happens. because it will. It's just, you might have to tune out the noise. You might have to really, really get thick skin. You might have to just, like I've been saying, do your own thing. Forget the crowd, because the crowd is what's going to go down, right? That is the crowd. In 2008, it's not like a few people got hurt. Most, 90-ish, whatever percent, devastated. Don't follow them off the cliff. So short answer, well, super short answer, I have no clue. Somewhat complicated answer, I mean, everybody's net worth, everybody's spending behavior, it's all based on inflated asset prices. If the S&P 500 went down 30% next month and your house price dropped 30% in the next year, would you go on a vacation? Probably not, right? But what about now? I mean, your home price is probably the highest it's ever been. You can't even believe the offers that people would pay you for that house. Your equity portfolio's at an all-time high. It's staggering. Yeah, go on a vacation. Go to Greece. Enjoy your life. Everything we do, even though you're not cashing out, all of our incentive and the entire U.S. economy is based on consumption and asset prices. How can they even allow that to fail? So they're going to try their best, and they're going to succeed for several years. And there's going to be unbelievable financial engineering for the next several years. And then when it's over, it's over. And when the musical chairs, when the music stops, you really do want to make sure that you were the first person in the chair, because it's going to be bad. It's not going to be a game where there's 10 chairs and 11 players, right? Oh, there's one poor guy who's out, they didn't get a chair, they're out. It's going to be a game with 10 players and one chair or two chairs. You better make sure you're, eye on that chair the entire time. So, all right. Don't lose a ball strategy. Yeah, that's my golf strategy. That's my investing strategy. And Vanessa, who's turning into quite the golfer these days, will attest to that. Don't lose balls. I'm talking directly to her right now. She's sitting in a coffee shop having breakfast right now. Stop losing so many balls, because you're way too good for that. She plays so well most of the time and then loses 10 balls. I mean, how can you shoot a good score 95% of the time? You're doing great. It's just you're losing too many balls. It's like those investors who they sell those UVXY calls and they think everything's great, and then boom, lost one, and then okay, I'm back, I'm doing great, had 4 holes in a row, boom, lost another one. Don't be that person. Don't lose the ball strategy. Don't suffer painful drawdown investing strategy. That's it. All right. Today was a weird one. I feel like it was 80% rant, 20% calm. I don't know, whatever. It is what it is. I'll edit it up and be surprised I said what I said. So anybody, thank you so much for watching. Like I said, if you did follow to the end, you can email me if you're interested in that strategy. I'll give you a basic tutorial, 10-minute video, 20-minute video. And tune in next time. Thanks, everybody. Hopefully I didn't ruffle too many feathers.